delighted to do that. I'm really looking forward to hearing and having your questions in the chat for later. But it brings me great joy to introduce our special guest here, Shamubeel Eaqub, who's joining us to talk about addressing the infrastructure deficit. For those of you who don't know me, my name is Craig Renney. I'm the Economist and Director of Policy at the New Zealand Council of Trade Unions, Te Kawe Kamahi. The CTU is a member of Tax Justice Aotearoa, and we look forward, as we get closer to the election, and just generally talking about how we build a better tax system, how we build a better economy, and how we build all of those things to help make sure we have a better Aotearoa. For those of you who never met Shamubeel before, or don't know who he is, you must have been living under a rock in New Zealand for a long period of time. Shamubeel is one of our premier economic commentators, and is the communicator about economics that I wish I was. Shamubeel is here to talk about the infrastructure gap, but rather than me gabbling on about who you are, Shamubeel, why don't you introduce yourself to the audience?
Thanks, Craig. Look, Craig, we've known each other for a long time. Before I start, I thought I'd give you just a little plug for these 2 books that have just landed in my mailbox today. It's all about poverty, and that's going to be the topic of the webinar next month. So please join in, because some fabulous stuff won in the book, but hopefully some conversation.
Dave, yeah. Can you up the volume just a wee bit?
So I think you asked me to introduce myself. So my name is Shamubeel. I'm the Chief Economist at Simplicity. Part of the reason why I guess Glenn asked me to speak about infrastructure today is because I wrote that paper for the Infrastructure Commission on the size of the New Zealand infrastructure deficit. And there was only one perspective, and so today's talk is going to kind of cover a little bit of that.
I send
I'll offer some thoughts on some of the solutions. I won't have all the solutions, but hopefully what that will mean is that we'll be able to have a good conversation in the Q&A afterwards. So Craig, unless you want me to talk about myself more, we can maybe jump into it.
Speaker, shouldn't me?
Delighted to Shamubeel. Thank you for joining us. Just before we jump into that, I just want to give a small plug. We are hoping that people who are on the Zoom might be willing to volunteer with future, better taxes for better future campaigns. And if you're willing to do that and you want to help, please sign up by clicking on the link that's currently in the chat. So I'll stop there. And Shamubeel, please, the floor is yours.
Thanks. Look, these slides are very much based on the report that I wrote for the Infrastructure Commission a few years ago now. And so it's a little bit out of date, but I think the broad story stands, and it will give us the right foundation for the conversation around what are the kinds of levers we can pull and what are the kinds of constraints we're trying to resolve with the infrastructure deficit. Before I get started, I just need to give you a small disclaimer. Because I work for Simplicity, which is a KiwiSaver provider, we are a regulated business, and anything I talk about today is general in nature and is not financial advice. So I'm not allowed to give you financial advice. So that's done. So these are the big kind of themes that I want to unpack today. The first is around, I guess, the state of our infrastructure. New Zealand is not in crisis, but we certainly have a big deficit. It's still quite resolvable, but it requires some very significant efforts over the course of the coming couple of decades. We've got some big demographic shifts that are coming through that reduces our time horizon in terms of when we can deal with it before other pressures come along. I think there's a few dimensions where these pressures are really building up. First, around politics. So much of infrastructure decisions are political, and they will always be. So when people say we should be removing politics, I think that's a little bit naive. I think we should be asking for politics to be removed from short-term infrastructure decisions and having those contests about things that might be happening in 5 years' time, or 5 years' time, or 10 years' time, rather than those immediate changes in investments. Finance is quite a big issue. So whether it's real or imagined, fiscal pressures are a very dominant force of conversation around infrastructure. This is actually more so for local government than it is for central government, because local government has really borrowed up quite a large amount of money and has been quite bad at dealing with its depreciation or otherwise the renewals and maintenance of the existing assets. When it comes to investment and maintenance, those are the two parts of the same thing. The politics and the finance comes in quite closely in that. We quite often like to have projects that are new, big projects, we want to cut the ribbon, but it's unsexy to maintain the assets that we have. So a lot of the deficit that we currently have is not necessarily that we didn't keep up with the growth in the population, although it did happen, or the growth in the economy. A lot of it is because we underinvested in terms of the maintenance of the assets that we have. And that's particularly true in underground assets, which are out of sight and out of mind. So some of the ideas that I want to put forward today is it starts with a little bit of understanding. And I think a lot of the work that's been happening by the Infrastructure Commission over the last few years since it started has really been about giving a much more consistent, hopefully evidence-based approach to understanding the situation in terms of what's going on in infrastructure, what's needed, and what are the levers that are available. But they're not the ones who are going to be able to manage the trade-offs, which is an inherently political and cultural issue. And I think that's where a lot of the tensions are arising. But we're seeing lots of changes in conversation where our political parties are talking about more consensus-seeking ways of doing infrastructure. So far, I've only seen words. We haven't seen any real actions that is the case. But I think what we are talking about now is how do we reduce political uncertainty? And I'll offer some thoughts on that as we go along. I'm a nerd, so I like lots of pictures, but essentially the picture on the left-hand side shows you a little bit of the reason where I think we've kind of fallen behind. So there is no kind of magic number in terms of how much investment we should have, but if you kind of look at the kind of historical averages and what's going on in the private sector, that picture on the left-hand side kind of shows you what should have been happening. So that light green area is the amount of maintenance of existing assets. The dark green area is essentially the net new stuff we've been building. And that orange stuff is what we would have been building if we're keeping up with the wider growth of the economy and population. And that accumulation of that orange area is really what we're talking about when we're talking about the infrastructure deficit. So it's not just that. If you kind of look at our investment on surface kind of infrastructure on the right-hand side from the OECD, you can see that our investment tends to be in the lower quartile of the OECD, which is unusual if you think about New Zealand's geography, where we have a long, skinny space. We have a very scattered, low-density population. You'd expect us to be on the higher end rather than lower end. So there is kind of, I think, multiple ways of thinking about where we might be falling behind. And I think the data shows that pretty clearly. Now, the idea of the deficit, the reason why we did that work a few years ago was not because there is one perfect number, but because a number like that can help people galvanize around it. So there are lots of different approaches in terms of how you might think about the deficit when it comes to infrastructure. Some of it's around cross-country comparison. We didn't do a lot of that, but I think the Infrastructure Commission has been doing some good work around that recently. A lot of it's around the bottom-up, which is that going out to the local community and going, given what you have here versus what would be ideal for a community, what does that look like? That's the kind of gold standard. We haven't done that yet because it's quite time-consuming. It's very resource-intensive, but I think it's an area of work that we will have to do more of. You would have seen that the Infrastructure Commission has now got a pipeline of work that's being published regularly, which is really, really useful. But what it doesn't yet do is clearly define the goals of what those infrastructure assets would do and the trade-offs that we have to make when we're making those investments. And it's the trade-off part that's really difficult because we keep on seeing our political masters offering up, I'm going to do this, and you know what? Your taxes are not going to change. Our debt is not going to change. It's going to be done on time, under budget, and all those kinds of things. And we're getting promised all these unicorns that they are not able to deliver. And then there was the piece of work that I did, which was the top-down look, which is a very macro perspective, just thinking about looking at overall trends in history. What does it look like? It's very much indicative about the size of the deficit and thinking about those slightly moving, the moving parts underneath it. So then we can have a more fulsome conversation about where we might look closer. One of the things that came through very clearly when we're doing that work was that it wasn't just one source of that deficit. And I kind of talked about the underinvestment maintenance that went on, but also there was a whole bunch of other kind of underlying reasons and uncertainties around each that led to it. The first was around, I guess, things like demand forecasting. The population growth that we've had in New Zealand has far outstripped projections. And it's been happening in many different places, including in the provinces of New Zealand. You might know I'm quite infamous in Wanganui. I called it a zombie town once. And the timing was absolutely perfect, right? Right after I called it a zombie town, after nearly 20 years of stagnating population, the population of Wanganui started to grow massively, just to spite me. And now it has been a massively growing economy. And so if you had major infrastructure plans on the basis of stagnating population, all of a sudden, all your plans and projections went out the window. So huge amounts of uncertainty there. There's also issues around coordination, and we see this all the time. Coordination between politics and the agencies, coordination between the agencies and the people who do the work, coordination between the people who own the assets and people who manage the assets. There are lots of issues there where they're not working as well as they should. And that leads to some big issues in terms of why we're not maintaining our investments and why we're not investing to keep up with things as they come. There's also been issues around financing and funding. I think there's a lot of politics in the way that we think about financing and funding. On the left, it's very much a strong view. It should be all borrowed and funded out of tax and debt. And on the right, there is a real push to move towards privatization of these assets and private sources of funding. The happy medium is probably somewhere in the middle, that there are probably other ways of doing things. But I think we should not get too caught up in the funding and financing question first. I think we should figure out what we need to build and whether they're public assets that have financial returns or not, and then think about it specifically about each of those assets and investments, how best to line up the funding that's required. And there's also been an issue around delivery. As you know, in New Zealand, when it comes to our construction sector, infrastructure productivity growth has been really quite shocking. Part of the reason why that productivity growth has been shocking is because we have so much boom bust in our construction cycle that it's very difficult to get top of the range skills, top of the range kit. And as a result, we are always behind from the rest of the world in how we do our work. It's not that we don't know how to do it. It's just that if you don't have a sufficient pipeline of work from a monopoly buyer, in this instance, mainly government, either local or central, then you're not going to make those investments. I did a piece of work for KiwiRail a couple of years ago, and it was really fascinating. It was mainly kind of interviewing people in the industry, in the delivery space. And they said, Shamubeel, it takes us 2 to 3 years to train somebody up to be able to do it well in the New Zealand context, because there's always kind of quirks of a local market. But once we lose that person, they're going to go to Australia and they're not going to come back. So it's really, really difficult for us to kind of recover from these shocks when they arrive. There's also quite a lot of this infrastructure deficit that's come through because of just sheer growth of our population and economy. And roughly speaking, when you think about the growth in the population, on average, we need about $180,000 worth of new investments for every new household in New Zealand. That's across both local government and central government. So this is everything from the water infrastructure, the road infrastructure, the schools, hospitals, all that stuff. But that's a fairly large chunk of money. And it's a particularly big issue for local government, less so for central government, because when you have a growth in the population and the economy, the government takes a good cut of it through its taxes, whether it's taxes on work or profits or GST. In contrast, local government really doesn't get the benefit of the growth. So when you see that strong growth in population, the costs wind up really, really quickly. But even the rates that these additional households pay, they're not even enough to pay the interest on the additional debt that's required for the infrastructure. So there are some really big challenges in the local government sector, in particular, when it comes to the meeting the growth rate that's there. So essentially, when I think about local government, it's really well set up for places that grow modestly and predictably. Any place that doesn't grow or grows really fast, the current settings don't work. So it's one of those things where I think we do need to have a much bigger think around how we consider the taxation system, including rates, because that's, of course, one of the taxes. It's very low relative to, I think, what we get. I went for a walk earlier today around my neighborhood, and I was talking to my wife, Selena, that we are actually quite blessed in terms of how much value we get for the rates that we pay in Auckland. The quality of services, the quality of the assets is pretty spectacular. I know we all like to bitch about it, but the reality is that we're actually very, very lucky in terms of what we get for a relatively small amount of money. And that's because it's distributed across so many people. But it still doesn't mean that those rates are sufficient to fund the growth of Auckland. So there are some big challenges there. I'm probably belaboring the point here, but this idea around maintenance is a really big one. And I think this is the one that is politically the easiest to kind of delay and sweep under the rug. And one that I think stops people from making the total amount of investment that's actually required. And we've seen this particularly in local government over a number of years where we promised to have lower rates to be able to, essentially by deferring maintenance. And that's been the thing that's really caught up with us, that typically, if you look at the depreciation of our infrastructure assets, which is not very different from private sector, this is true for pretty much all parts of the economy. But roughly speaking, for every new dollar that you spend on CapEx, about 60% of that will go towards maintenance. So 60 out of a dollar, so you only have 40 for the new stuff, the whiz bang stuff, the new stuff where you get to cut the ribbon. There is actually not a lot of dollars for that. So politically, that's a really big challenge because it's quite performative when it comes to infrastructure, right? It's not enough to get on with it and just fix the stuff that you have. That's not sexy. You got to show the new brand new motorway or the brand new whatever it is that's going to give us those benefits. And so you can see on the right-hand side that it's whether it's the private sector or the public sector, it's much the same in terms of roughly around that 60% depreciation rate or depreciation that consumes our physical investments. And you'll see there's quite a lot of volatility in the 80s and 90s period where there were huge amounts of asset write-downs that were taking place when we sold off quite a lot of our crown jewels to foreign investors because, we felt like that was the right thing to do at the time. There's a couple of things that I think come through, and it's probably doesn't sit nicely here, but it's an important thing to think about. Economics and infrastructure, I guess they're both inherently political. And that's what we see in terms of the decision-making when it comes to infrastructure investments. If you look at the picture on the left-hand side, that's from the long-term plans of local councils. That was the last big review. I haven't checked the numbers this time yet. But essentially what you can see is that they should be investing about 60% of their capital into maintaining their assets, but they're only investing 40%. That's how much they're planning to do it. They're spending quite a lot of money on improving the quality. So this is things like, increases in water quality standards and those kinds of things. Those are good things, but they have to be funded from somewhere. And so quite often what we have seen, particularly in the space of local government, is we'll see central government direction on, oh, you must do this. These standards will lift, but there will be no commensurate mechanism to actually pay for it. There is no resourcing and capacity to fund those changes. And then we're spending about a quarter of that money on meeting additional demand. Those are what's planned, but what we find on the right-hand side, if you see those dotted lines, those are the plans in the LTPs, and the shaded green area is what was actually invested. So in local government, they end up investing more than they have planned. So we are planning to fail. So they're saying when we do the long-term plans that we think investment will kind of go sideways from here, even though that has never happened, right? It's going to do that. And that's my problem here is that when the growth turns up, the council has no defense. It must provide the capital. It must provide the infrastructure. And it ends up investing a lot more that's unplanned. So there is, even though the long-term plans provide quite a lot of transparency, I think over the course of the last 3 tranches of long-term plans, what we have seen is, 1, we're planning to fail, and number 2, we are failing to learn. And there's some really big issues here. So when it comes to local government, what we're seeing is that they're under planning relative to what they actually end up investing in, and then they don't put through the rates increases, and that's why debt has been growing so rapidly. In central government, the problem is reversed. And it's really funny because it's all about the psychology. I think it's the signaling that goes on. On the left-hand side, you can see the cash flows from central government on purchases of physical assets. And those dotted lines are what were predicted in successive budgets going back to about 2015, sorry. But essentially what you can see is the projections are, oh, we're going to spend tons of money. We're going to be amazing. Every government does it, right? We're going to be just awesome. We're going to invest the hell out of it. And then the actual reality always seems to track a lot behind what it was. So it's almost a reversal of local government. Local government plans not to invest very much, but ends up investing more. Central government plans to invest a lot of money in a hurry, but it can't. And so there is some different failures that are taking place when it comes to central government. Partly it's to do with some of those coordination issues that I talked about before, and partly to do with, I think, a lot of political imperative in terms of the timing of it, rather than the real timing it takes to get these infrastructure projects done, which are complex, long duration, all of those kinds of things. And I think on the right-hand side, you can also see why those projections of rapid increases in spending are not flowing through. On the right-hand side is the last iteration of the infrastructure pipeline from the Infrastructure Commission, and that solid green bar is essentially what's fully funded in terms of projects. And what you can see is that for the first year, there is plenty of money that's fully funded. And pretty much after that is like a cliff face. That is actually not a pipeline, it's a cliff. And when you've got a pipeline that essentially looks like this, it's very difficult to plan ahead and get all the resourcing in place and actually maintain a steady level of capacity and delivery, let alone to increase it as those projections from successive budgets have shown. So there is two different types of failures that are taking place in infrastructure. One, we're failing to plan. In other ones, we're failing to execute. And there are different kinds of failures that are taking place when it comes to our wider infrastructure delivery. And there's a whole bunch of political constraints that are there, whether it's, again, like I said before, whether it's real or imagined. On the left-hand side is a picture of government's operating spend in cash flow terms, not in the P&L kind of, the accounting stuff. Mainly because I always find there is just so many category changes that takes place in the in successive budgets. Very hard to keep track of these things. I'm looking at Mr. Renney there because he was part of it at one point in time. But cash flows you can't hide, right? The money spent is the money spent, and the light green bar is the amount that we spend on capex. And so what you can see over time is that our total expenditure in the economy from central government ranges somewhere around 40% and it kind of cycles up and down, and you can, I think, see the political cycles in that pattern. And I think there's been a lot of talk about how there's been a lot of fiscal austerity under this government. Well, not yet. There's been very specific types of cuts that have taken place, but actually in total, they're still spending more in OPEX. The biggest crunch so far has in fact come in CapEx. And that CapEx reduction has really hurt people in the infrastructure delivery side. I was speaking at the Civil Contractors Conference in Tauranga a few months ago, or maybe a month ago, and it was a very, very gloomy room. In contrast, the most happy room that I've spoken to this year is the insolvency and restructuring people who are restructuring a lot of these construction companies. So, two sides to the same coin in some ways. But you can see the forecast in the last budget that there is a lot of austerity that's planned should current trends continue. On the right-hand side, you can see where the talk of fiscal constraints are coming from. So when you look at the amount of debt, this is gross debt, relative to tax. In the green line is central government, so that's total tax take, and in orange line is local government, which is just rates revenue. You can see that when it comes to the tax cover for central government, our current level of debt is relatively high, but it's certainly not unmanageable. So there is very much a political judgment here in terms of how much debt is the right amount of debt. But I would say there is a secondary question which is really important. It's not just about how much debt you have, it's about why are you incurring the debt. If you're borrowing money to plug shortfalls in operating expenditure outside of crisis times, that's wrong. But if you're borrowing money for particularly for investments and particularly for short-term crisis response, then that's probably okay. And if you look at what's going on in local government, I think the story is much harder to square in that we can't look at the big increase in debt over such a long period of time and say it's a short-term thing. I think it's a structural thing. So relatively speaking, local government is, I think, at its headroom in terms of how much more money it can borrow. So it's very much against the wall. So I think reforms are going to come at it thick and fast over the coming years. And it's a sector that's going to be under a lot of pressure. Central government, I think, still has headroom, relatively speaking. And whether or not we borrow money for investments will be very much a political and ideological decision rather than an evidence-based, market-based decision. I mentioned unicorns before, and I think my kind of take on this is that because the politics has become just so fractured, our politicians do not feel like they can offer things that are slow and gradual and benefits are realized somewhere outside of their political term. As a result, they are forced into making these extraordinary promises that they simply cannot deliver. And I kind of describe them as unicorns. That's my Venn diagram on the left-hand side. I use it a lot because everybody wants to offer something that's good, cheap, and fast. But we know from experience that doing all three at the same time is really, really hard. And in reality, you have to choose two of them. So the choices in front of us are either we have projects that are expensive, projects that are slow, or projects that are low quality. So nobody wants to sell something expensive, and nobody wants to sell something slow, and nobody wants to sell something that's bad quality. So what do you sell? And the reality is we have to make those trade-offs. And somewhere in there, you have to choose that actually there is no way for us to have this infrastructure deficit or the infrastructure that we want invested and paid for if we don't make some choice in terms of either paying more or being patient or doing without something else. And I want to kind of just sort of clarify that earlier comment on the picture on the right-hand side. That's the net cash flows that I kind of look at to make sense of why we're borrowing money. The green bars are operating balance and the orange bars are investing. So generally speaking, I would expect to borrow money to make investments. That's the right thing to do, right? Because you're making an investment in an asset where the returns will accumulate in the future. So that's okay. It's intergenerational stuff. But when we're borrowing money to plug the short-term shortfalls, there is a problem. But you can see over this picture that over the course of the last decade, we've borrowed money for those day-to-day spending quite often. Initially because of COVID, then again because of COVID, and then more recently because we want to give tax cuts and hoped that it would be paid for by other stuff. But essentially, if you look at this picture, over the course of this time horizon, we're going to go through 1, 2, 3, 4, 5, 6 out of these 10 odd years, we're going to be borrowing money to essentially pay for the everyday goods. There's a real problem here. So despite all the talk of fiscal constraint and fiscal management and fiscal responsibility, the actual performance of New Zealand over the course of the past decade is we've been quite profligate in the way that we have borrowed. We have borrowed to plug short-term spending shortfalls, and we have not chosen to make trade-offs. So there are some really big challenges here, and I think there's a more systemic issue that we can see in government decision-making, which then flows onto the decision-making that we see in infrastructure as well. And I won't dwell on this, but I think it's helpful to keep this in the back of our mind when we think about why we don't have a huge amount of time to get on top of the infrastructure investments that we want to make, because our demographic is coming at us really rapidly. 20 years ago, we had about 8 working age people per retiree. Currently, we have about 4. In 50 years' time, we're going to have 2. So given our tax structure at the moment, and I say at the moment because that's the issue, if we don't change it, it's going to be hard. Given where we have the revenues less transfers, which is the picture on the right-hand side, the net flows, you can see most of the net flows happen from the ages of about 25 to the age of about 64. So when we have a population that's growing much more in terms of the older age groups, we are going to see that change really rapidly, and our fiscal headroom is going to deteriorate quite significantly. Essentially, we went from a tax structure that was structurally surplus producing, and now we're moving to one that's structurally deficit producing. So there are some really big shifts we need to make, either around tax or around spending. And each of those come with some very significant trade-offs because we all rely on many of these public services for our lives. There is a few kind of consequences to this political uncertainty and this flip-flopping stop-start that we see, and it shows up in the capacity in the sector, for example. So when we had the GFC, for example, it took about 3.5 years for us to kind of recover from that fall and then coming back to where we were. But like I said, when I was doing those interviews with the Kiwi Rail delivery companies, what they said was, once you lose those people, getting back up to scratch is time consuming, is low productivity and high cost. And in fact, we can kind of see across the infrastructure bill for New Zealand, that period or during the GFC, because of the lost capacity and that expensive rebuild, we probably experienced something like $765 million of additional inflation than would be the case. That's a ton of money to essentially say, I just want to stop things today because I don't feel comfortable spending through the downturn. And it makes no sense to me, right? every economics textbook, from particularly the Keynesian textbooks, will tell you that when there's a recession, it's the perfect time for government to spend on infrastructure. You're going to buy this stuff anyway. You may as well do it while there's a downturn, plenty of capacity and all those kinds of things. Now, it's not just those cycles, because I showed you the picture of the pipeline, and that's not a feature of the economic cycle, that's a feature of politics. There is a huge amount of money that's funded, huge amount of work that's funded for the next year, but very little for the years afterwards. And we see the same pattern playing out in terms of the labor market. We don't retain our people very often because our companies are constantly changing, and people can't see a future for themselves in the sector or in the job or in the company. And as a result, what we find is somebody who's hired, within a year, about 40% of them would have left. Within 2 years, 60%, 61% would have left for something else, which is an extraordinary thing, right? So if you think about it, like 61% of people you've hired are gone within 2 years. And it takes that long to get them up to date in terms of skills, get them to be productive, all those other bits and pieces. So these consequences of stop-start, this political uncertainty and uncertainty in general, is not just that we're not doing the work, it's also that these companies and the people that we have are not necessarily performing at their best that we would like to see. So that productivity loss, or the low productivity that we see, is not surprising. So this was the slightly complicated picture that we put in the report for the Infrastructure Commission, but essentially the idea was that we started with a deficit on the very left-hand side. We probably need to build a few houses, quite a few. There's a little bit of work that needs to go on in terms of sea level rise. There is a bunch of work that we need to do in terms of improving the quality, because we're kind of used to it. There is changes in the way that the economy is shifting. And then we have to cover all the kind of depreciation of the work, of the assets that we have, depreciation of the stuff that we're going to build. And then there's the depreciation of those catch-up things. So if we were to kind of build our way out of it, we would have to spend something like $1 trillion over the course of the next 30 years, which is an extraordinary sum of money. It's just not going to happen. I mean, and so I think this is the thing. It's like, I don't think we should assume that this needs to be resolved only with one tool and one lever. So we are already planning to invest quite a lot of money, but there is a big gap in terms of where we are, where we're heading. So, I mean, the paper kind of goes into a lot of detail about this stuff, but I guess when I was kind of thinking about it, one thing that really stood out for me was that infrastructure deficit shows up in a tax that we pay all the time, and the tax on our time through congestion, the inconvenience, and all those kinds of things. And so when we did that report, we worked out that, roughly speaking, congestion is costing New Zealand about 1% of GDP a year. So it's essentially either we pay the tax to government, or we pay the tax in our own times or in our own discomfort. So one way or other, there's a tax on something, whether it's real or imagined. But if I look at that as a one-off scenario, 1% of GDP is a ton of money, right? That's $4.3 billion. If we were to use that 1% of GDP to borrow money, that's $100 billion of debt at current interest rates. There's a ton of money that we could justify purely on the basis of the current amount of congestion that we're facing. If we were to take 1% of GDP growth a year, that would be about $225 million a year. That equates to an additional $5 billion of investment every year through debt. So I think it's not true that we have no headroom or justification to borrow more money to make these investments, or that we don't have the capacity, as long as the projects that we're investing in are high quality and are returning economic returns. But essentially, I don't think this is about a justification that's based on economics or fiscal prudence. It's very much based on, I think, political realities of what they're willing to justify within the constraints of their own political ideology. And there is I would say this, of course, because I work at Simplicity, but I think there is also another option that's used elsewhere that we should be thinking about as well. And partly that's a quasi-public ownership. And what I mean by that is, if KiwiSaver funds own some of our assets, is that really private ownership, or is it public ownership? Because there is 3.5 million New Zealanders who have KiwiSaver, right? So it's almost, in my mind, it's public ownership without the government, and it might be one of the routes about reducing some of the political uncertainty. But the picture on the left-hand side just gives you a reason why we're thinking about this a lot. So KiwiSaver is already pretty big, and it's growing really, really fast. We are within the next 20 years, we're going to get to the phase where the returns on investment will exceed the contributions we make from our wages. That's when that's when the flywheel really takes off. You kind of get that upward curve. But essentially, if we wanted to invest some of that money into our infrastructure, that KiwiSaver assets, we could actually buy a whole bunch of stuff. We could easily fund 2% of GDP in new investments in New Zealand for the foreseeable future, which is an extraordinary sum of money. But it would still have to go through the usual issues of who owns it, are there kind of returns with it? Because if I'm an investor buying the stuff, I need to have some returns. But there's plenty of capacity, and it's long-term patient capital. By 2028, we should be able to meet all of the historical deficit. By 2048, we should be able to essentially do nation-building stuff. I think politically there are some benefits in that because the costs and benefits are borne by Kiwis, not all, but lots. I think there is a real upside there in terms of even if we're paying for services, you're not paying for services that exit the country, rather it's being put back into New Zealand owners. And also, like I said before, there is a broad idea in my head where KiwiSaver ownership is a little bit like public ownership with other government, and it doesn't have some of the same issues as foreign ownership. But I think it's about pulling all the levers. When it comes to population, I think we have an immigration policy that's essentially made up on a whim at some point of the economic and political cycle, rather than having a consistent long-term kind of state that we pursue. As a result, I think we create a lot of high levels of demand in very short periods of time that creates lots of demands on our infrastructure that we can't deal with. Certainly, I think there are some pressures that come from the economy. I'm less worried about that in terms of managing that. I wish we had a bit more of those pressures at the moment. A little bit more economic growth wouldn't go astray. I think there's a lot of benefits that will come through technology. So some of the technological changes can increase demand. So think about the electricity sector, but some of the technology can also reduce demand by making better use of your existing assets, particularly if you do demand management and that kind of stuff. And I expect we'll see lots of additional demand for infrastructure through climate change. The responses can be on the right-hand side, which is around new infrastructure. I think that's the first one that we all go to. Yes, we should do that. But also, I think there's a lot of efficiency gains of existing assets that are possible. So we can use our existing assets better. For example, bus lanes on existing roads can massively increase throughput. So that's one example of doing that better. Demand management, so time of day use, T3s that are time limited, those kinds of things can be really useful in terms of, again, getting more out of your existing assets. And the final thing that's taking place at the moment, which is around spatial planning, getting a lot more people living on transport corridors and nodes, so then we're not gumming up the system. So there are lots of different responses. This is not exhaustive, but I think we should be pulling all of those levers rather than thinking we're going to just build our way out of it, because I don't think we can afford it. Now, this is a very crude kind of picture in my head in terms of how I think about it. I think the first two kind of solutions are around borrowing more and having tax that goes with it. And there are two kind of private capital solutions, which is around foreign capital and local capital. When it comes to the politics, I don't think we have consistency across the political spectrum to have more debt and more tax. So I know the left of the political spectrum is very happy with it, but I think the right of the spectrum is not. So it's not going to be consistent through the political cycle. With foreign capital, the right of the spectrum is happy with it, the left of it is not. So again, it's not consistent. With local capital, I think we could sell it to everybody. So it kind of meets it, but it's not right for every type of investment. When it comes to finance and investment, I think that stuff is less problematic. I think the biggest challenge we have is around maintenance. When it comes to maintenance, we're finding that it's really, really difficult to take on additional debt, particularly in local government, to do the maintenance work. So they want to use the debt to fund those big stuff, but they don't want to use the debt for the unsexy stuff. And yet we know that we have to find a way to manage those pressures. So there's no perfect answer here, but I think there are ways for us to think about how do we get the right outcome with each of these tools when we're thinking about meeting our infrastructure deficit. So I'll finish where I started, which is around just a reminder that we do have a big deficit and it has accumulated over a long period of time. It has mainly happened because of our inability or unwillingness to maintain the assets that we have, but also because of increasing demand and changing kind of makeup of the economy. My personal belief is that because of our demographic pressures, we have a relatively short window of time before those the ability to use the Crown balance sheet to solve it will diminish. There are a few dimensions that I think about, which is around politics, which I think is the most dominant dimension that we need to think about. And then there is the funding and financing, whether it's done out of tax or debt or private capital, whatever. And then there's the issues around, do we invest more? Do we maintain? How do we get the right balance? And the ideas that I started with is really around, hopefully today's conversation is part of this, which is around a little bit around understanding. But the main thing that we're dealing with is managing those trade-offs. I think that's the one that we're unwilling to do. And that's why we see so many unicorns being promised. And fundamentally, any progress that we make needs to be sufficiently good that it reduces political uncertainty, at least for a period of time. That's the thing that we're looking for. I don't think we can be complacent in thinking that we have easy answers in terms of how to do that. So I might stop there because I've kind of talked at you for a very long time and open it up for questions that I think Craig will pose to me.
Thank you, Shamubeel. First of all, before we crack on, thank you so much for your presentation, for talking to us. It didn't feel like a long time, so don't worry about that. It's very clear, very concise. And can I just say, one of the things that economists do is make people miserable. It's called the dismal science for a reason. And I think one of the things I took away from your presentation was actually there's some hope here. We can make some choices. We can do some things, and get better outcomes. So in that optimistic vein, I'm going to take this opportunity as the person I'm saying this to ask the opening question, which is, if we could put politics aside for a second, which is a big if, but if we could put politics aside, do we have our tax settings right to deliver the infrastructure that we need? Or are there tax tools we could be using to help manage our infrastructure needs better?
Really good question. I guess the reason why I'm hesitant to say that we have the right tax settings is because tax settings are inherently a reflection of our political settings and political preferences. And I do not think we have sufficient agreement across the political spectrum about the right amount of tax that we should pay. And the way that I describe it, and Craig, you and I have had this conversation many times, is we can't start with how much tax we should pay and then figure out what we spend. I think we should go the other way and go, what are the public services that we want in New Zealand? And then how do we pay for it? And who bears the burden of that? And because we start from a top end, we've already constrained ourselves. And as a result, we're unable to have, I think, a grown-up conversation about the types of tax and who pays the tax for the public services that we agree that we want. And so I think the whole conversation around tax is a little bit upside down in New Zealand. It probably is everywhere else too. And therein lies, I think, my challenge is I don't know how to answer that question.
I fear it'd be a question that if we did get to an answer, people would disagree with it anyway. But questions are flooding in to the chat. You'll be pleased to hear. So it's not just me. So can I start with one that's getting a lot of love in the chat? If we use congestion as a measure of how we can make sure, how can we make sure we don't just simply repeat the past mistakes of motorways being the solution? How are we building infrastructure to actually tackle our long-term needs, not just alleviate the pinch points that are here right now?
Yeah, really good question. And I think we have relied on building our way out of issues rather than using all the levers. And I think that was kind of that slide that I had around pulling all the levers. It's about not just building more assets, more new investments. It's also about managing demand, having pricing on it, and those kinds of things. But I think, again, it goes back to that underlying political issue is we're unwilling to bear the cost. We're willing to bear the cost of congestion, but we're not willing to bear the explicit cost of a tax, which is bizarre to me, right? It's kind of like you're paying this tax one way or the other. It's not like it's a made up thing. And whenever you talk to people about Auckland, that's the first thing they talk about. Oh, you've got a lot of congestion. It's like, yes, but what if we had a price on the congestion and we didn't have that congestion? Instead, we had a price. Would you prefer that? But people are not willing to contemplate that yet. But as you know, Craig, we've got plenty of examples from around the world that congestion pricing done right can have very beneficial outcomes. as long as we take into account the equity issues, because we know that quite often the people with the lowest incomes get hit the hardest. So as long as we're able to cover that, which I think is entirely possible, then it does work. But the caution there, of course, is that we know that those support for poorer people in particular quite often gets taken away when there are changes of government. So, poor people are not seen as vote winners, and quite often those things are at the political whim. So I struggle with the idea that we can get a condition pricing that's sufficiently big, that has sufficient safeguards, that is going to last the distance.
Thanks. We've got a couple of questions that have come in about alternative financing mechanisms, in particular, monetary financing or the use of sovereign credit. Same thing, essentially. Do you have any thoughts on whether or not this is an area that New Zealand should be going down? It has done a very long time ago in the past, but not of any recent experience. Do you have any thoughts on that as an issue for tackling our infrastructure gaps?
Yeah, I mean, I think I get emails on that theme quite often, Craig. I'm sure you do too. You probably know more about this than I do, but my sense has been that we had that opportunity through the period of COVID when there was a lot of political and market willingness to overlook unorthodox ways of doing things. I do not think that is the case at the moment. So you look at what's going on in the US, for example, with the attack on the institutions by Trump, and the US bond yields are essentially the same as New Zealand. Essentially, what they're saying is the country risk of America is the same as the country risk of New Zealand. What an extraordinary statement. So I don't know what you're doing there, but so I think there is an element of that in my mind where I don't think it would be unpunished. I think what we would see is that if we went down the monetary financing path, that our cost of debt would go up. So you'd pay for it one way or the other. It has the benefit of, I guess, not having to raise your taxes. You just do it through a higher cost of funding.
Thank you. That's a very fair point. Now, I'm getting there's a question in the chat which is getting a lot of love, which is about keen to hear your thoughts on where a capital gains tax or a wealth tax should be introduced to generate the necessary income and or to achieve better equity. Do you have any thoughts on whether or not we should be delivering either of those?
Yeah, look, I think really good question. And again, I think we're jumping into the tax policy before asking what are the public services we want. And I think we as a group might agree that there are particular types of public services and assets that we want, but I don't think that's uniform across New Zealand. And herein lies the problem, is because we haven't agreed, it's very difficult for us to then agree to the tax to pay for that, because that's the quid pro quo. In the long term, do I think we will need some kind of alternative additional tax mechanism to essentially raise revenue from capital income? The answer is absolutely, because I showed you that chart of our existing tax settings. It's just not going to work. So we're going to have to find something different. But I think there is a really big task of selling that in a way that's politically palatable. And some of the ideas that I've had pitched to me, because I don't know why people like to send me emails, is what if instead of just having a broad capital gains tax, it was hypothecated that there will be a capital gains tax or a wealth tax, but that will be used only for critical public infrastructure. And so you've got that ability to say, yes, I'm wealthy and I pay a little bit more tax, but I know where the tax goes. And it is ring fenced for this one particular use that is outside of that everyday political bickering. So it might be one of those things that can do it, but the reality is that currently where our politics is, if a capital gains tax was introduced, it would be undone in very short order, in which case, what's the point?
Quick question from our colleague Max Rashbrook, who's clearly on call and listening in intently. A couple of questions on KiwiSaver investment being quasi-public ownership. Is this slightly undermined by the existing inequalities within KiwiSaver? Some people have very little saving inside KiwiSaver. And would there be a trade-off for KiwiSaver members, i.e. would investing in New Zealand infrastructure return less than other options, which might be less important for tall, handsome economists like us, Shamubeel, but if you're on a very low income and have a very low KiwiSaver balance, becomes more critical to your longer term savings?
Yeah, really good question as usual from Max, I guess. I guess the way I think about it is there will be inherent inequities, anything to do with anything funded out of wealth, because wealth is disproportionately distributed. So that I think goes without saying that it'll be disproportionate. So I think we should be mindful that that is a given when we go to private financing. Private financing will inevitably favor those with more resources. But in terms of whether or not it would be lower returns, the answer is not necessarily. So all the work that I have done shows that infrastructure investments sit somewhere between bonds and equities. So it's more of a complete portfolio rather than an alternative to existing asset classes. So it provides you more choices, different ways of doing things. So it tends to be more consistent long-term returns. And so it plays a part in your portfolio. So if you have KiwiSaver, I hope none of your KiwiSaver is in single stocks or single sectors. You should really have it in diversified things because this is your long-term savings. But I'm not giving financial advice. It's really important that even for poorer people, we give them the security of diversification while trying to get the best returns over a long period of time. So no, I don't think I'm particularly worried that investing in infrastructure would mean as a result that you get lower returns. If anything, all the evidence of the US and Australian experience is the investment in infrastructure has boosted returns and given additional returns in economy through better infrastructure.
Following on from that, one of the questions we have here in the chat, do you have any thoughts on experts leading this work versus politicians in terms of investment? For example, the current challenges, let's leave it there, around the IREX program, the Cook Strait Ferry replacement. Experts have said one thing, politicians have said another thing. Do we have the balance right here, or do we need more separation like we have with the Reserve Bank, for example?
Well, that's questionable at the moment, isn't it, Craig?
The benefit of the tape, well, at 1:21 on Tuesday currently.
Yeah, look, I don't think it's a substitute. I don't think New Zealanders would countenance a situation where there is no political oversight of these massive decisions that have big implications for communities, because these are public assets that have consequences on communities, right? So I don't think you can take politics out of it. So politics is important. But I think the use of experts and the role of experts needs to be elevated. And it's about where in the decision making and where does the politics come in. So I think the politics, again, like I said, when I look at the way that the infrastructure pipeline works in Australia, they're fighting really hard for a project that will start in 7 years' time. I love that. Not the project next year, but the project in 7 years' time. And what's already been agreed and funded, that's done. Move on, right? That's not sexy anymore. We've moved on from that. So I think what I would like to see is that expertise right at the beginning to make sure we have the trade-offs really well identified. We've thought about these things really well. We've got the best policy, best projects, best design of the project, the best delivery of the project. The political contest happens, and then we have agreed on it. And then it goes back to the experts to execute. Politics is then removed. But politics then moves on to the projects much further on. So I'm laboring the point, but it is really about thinking, lifting our gaze and thinking further into the future. I absolutely do not want to see politics taken away from infrastructure decisions, which are fundamentally political. But what I don't want is the political interference to affect the execution and delivery of the things that we have already agreed
on. Question here about priorities. There's clearly a long list of things that we could or should be investing in. Are any of them more of a priority than others, given the challenges that we face? You can talk endlessly about housing or electricity markets or something else. Is there anything that, right now, in your opinion, is critical to closing the infrastructure gap, and some things that are perhaps more not nice to haves, but can come further down the list?
Yeah, I mean, it's a loaded question in the sense that it's not binary. These priorities are not binary, and you choose a selection of things. For example, if you want to build houses, you also want to make sure you've got the water connection, the sewage connection, and the transport. So, these are kind of coordinated things. That's the whole point of infrastructure. It's the network that allows the community to work really well. And so as a result, I think if I think about the kinds of things that I would prioritize or deprioritize, that might be a better way to answer it, is I would prioritize demand management over building new roads, for example, because we could get a lot more gains out of the existing assets that we have. So we buy ourselves some time so we get the right projects in place at the right time. So we get a lot more better value for money from that side of things. So that would be the first thing. I think it's really about just thinking about, can we give ourselves more time to get some efficiency gains out of our existing assets? That would be my first priority. The second one, as you know, Craig, I'm obsessed about housing, but particularly around social housing. I think that's the one I'd love to see, because the homelessness, the hunger that I'm seeing in New Zealand at the moment, and not just in statistics, but in real life, is extraordinary. There's been an expansion of poverty that's really quite distressing. I was talking to the City Commissioner, Auckland City Commissioner, yesterday, and the stories are absolutely harrowing. And we need to have these people well housed, so then we're able to essentially lift these people up, because there is just no other way to look after them. So I know it's not a great answer, but it would be very much around getting better efficiency out of transport in particular, because that would save a lot of money. And the other is around social housing in particular, because I think that's the first step towards trying to deal with a poverty issue, which I'm finding quite distressing at the moment.
Quick question here about sort of enabling infrastructure, because we've got enabling infrastructure to deliver our infrastructure. I mean, we know, for example, there are many fewer thousand people working in construction in New Zealand, and they're not hanging around. They're probably in Australia or somewhere else. But also historically, we've had an infrastructure, a construction sector beset by productivity problems. How do we get the enabling infrastructure right, the skills, the plant, the equipment, so that when it comes to building infrastructure, we can do that more productively, but also we can do it in ways that helps to reduce that boom-bust cycle we see in construction?
Yeah, it's a really good question. And I think essentially it is about smoothing out the boom bust. So construction will always be a little bit boom bust, because investment tends to be quite haphazard, right? So they're quite big, lumpy things. So it's by its nature, but it's possible to reduce that. And again, if I look to Australia, what they have managed to do with their pipeline is they've created a lot more certainty. So they've taken the edges off. Our edges are this big, their edges are this big. And that makes a big difference for the companies. So again, for example, when I was doing those interviews with the rail construction companies, they said, look, when we think about the investments we need to make in our operation in Australia, we know that we've got work for the next 7 years. So we can invest in some really big, expensive kit, train people up to do that, because it's in our interest to do that. And we know we'll be rewarded for making that investment. Whereas in New Zealand, we simply do not have the ability to do that, because the funding is not secure for 7 years. So, we can't do that. So it does come down to that, in terms of, if you can take that political risk away from that, that is what it is. It doesn't have to be that complicated. It can be just that these are the projects that we have agreed, we have signed a contract, and it's been funded, and it's locked in.
One very final question before we all have to wrap up. So I've saved the small ones to last. Local authority finance of infrastructure. Clearly, local authorities are at or close to debt limits. They are very clearly under much greater debt strain than central government. What's the solution here for local government that doesn't just involve putting yet more money on the rates or hoping for the best on debt?
Yeah, I think there's two things. One, local government is at its capacity that is artificially imposed. So it doesn't actually have too much debt relative to how much it could tax if it was given the ability to tax. So like I said before, the real issue for local government is that the way our local government is set up is it's designed to work for places that don't grow very much. And therein lies the problem. So places that are growing fast don't have the ratings mechanisms or sharing of that upside to help pay for it. So the best solution would be to actually have some kind of tax sharing. And that happens in Australia, for example, with the GST sharing that goes on. Something like that needs to happen, so we are rewarding the growth rather than centralizing all the benefits and localizing all the costs, which is what happens at the moment. And so therein lies the problem. So there are no easy solutions, because local government is always taken to with a beating stick, right? It's the easy one to kind of crush, because, well, no consequences. And I feel bad about that because I think local government does do an extraordinary job on relatively straightened circumstances. But we don't do a very good job of telling the story. But when it comes to infrastructure, the current settings are not fit for purpose. I think we have run to the end of that road.
Shamubeel, thank you so much for joining us. Thank you for giving us your time and your expertise through these questions. And thank you for everyone for joining us here at Tax Justice Aotearoa. As we advertised at the beginning, we'll be holding another event on the 7th of October, looking at poverty and inequality. So we look forward to seeing you there. If you look through the chat, if you go to the very beginning and you want to help out, you want to get more involved in Tax Justice Aotearoa, please, click on the link, help us engage with that. Once again, Shamubeel, thank you for joining us, and we look forward to seeing you all soon.